Okay, so let's talk about how do you form a corporation. Well, the first thing you do is you file an application with the state, an application of incorporation. Now, you would file with whatever state that you wanted to. Usually you would file with the state you did the most business out of. So, for example, if you're Seattle's Best Coffee, presumably you'd be filing within Washington, Washington State, that is. But the thing is you can really file and register with whichever state you want to. So a lot of major corporations use Delaware. And it may seem kind of odd. And here's an example of the companies or corporations who do incorporate out of Delaware. It may seem odd if you see the headquarters are all different places in Delaware for the most part. Actually, they all are. But the reason that they incorporate out of Delaware is because, well, there's a couple of reasons. First of all is that it's a lot cheaper. The fees are much cheaper to incorporate out of Delaware. Additionally, if you're not a resident of Delaware, if the company doesn't do any business in Delaware, then they don't have to pay Delaware taxes. I guess, this is one of the major ways Delaware must bring income into its state, is to offer these lower fees. So it's easy, it's inexpensive, and you don't actually have to pay taxes in the state if you're not operating out of that state. So Delaware is actually, pretty good place to be incorporated from. The other piece of it is, there's one more important point, and that is that Delaware has its own separate court system specifically designed for corporations. If you're in a major court battle, you probably want people who understand corporations and corporate law to be the ones making the decision for you. That would only make sense. The last thing you want is a corporation or rather people sitting making decisions for you, a judge making decisions that doesn't understand corporate law. Okay. Once the application is approved, the state grants a charter, or it could be called an article of incorporation, which is the formal creation of the corporation. In there, you're going to talk about who's going to be on your board of directors, what positions you're going to have, what kind of stock are you going to offer, what's your business going to be, how's it going to run, where its headquarters are, and so on and so forth. Okay, so it's basically like you're setting up the whole. Well, you're showing the entire setup of the beginning of your corporation. All right. Now, with this, you're going to have some fees as you handle all this organization of incorporation. You're going to have a lot of fees involved here, and those fees are going to all get journalized this way: a debit to organizational expense, a credit to cash. The idea is that those expenses do all apply to this period. You might think that maybe you would capitalize the expenses and then amortize them over time, but that's just not the way it is. The way it is what you're going to do is you're going to have all of these random expenses, and you're just going to simply debit the expense because it's reflecting an expense of the period. Okay, so let's talk about stockholders' equity. You can call it a number of different things. You can say stockholders' equity, you can say shareholders' equity, you can say shareholders' investment, which is not one that you hear very often, or you can say the capital in the corporation. Now, we've talked about shareholders' equity or stockholders' equity quite a lot, but let's talk about what the components are that are within shareholders' equity. The major components of shareholders' equity are either paid in capital, which is money that is being paid into the business in the sense of stock, usually treated as stock. Or the other major thing that's in stockholders' equity is the money the business is actually making, the net income. If you remember way back when we started all of these screencasts, chapter 1 or chapter 2, I believe, I want to say the beginning of chapter 2, we talked about how net income eventually flows into retained earnings. Okay, so all of the money that you make, that's ultimately where it lands on the balance sheet, is it falls into a retained earnings category. And if you also remember way back when, every time that we drew the owner's equity or shareholders equity T account, let's draw this for you guys, every time we did it, this is what it looked like. Okay, so maybe it's not my prettiest T account ever, but you get the idea. This is from way back when we talked about this a lot. I just wanted to remind you guys. So here we go. We have our shareholders equity T account, and increases to shareholders equity, which is really increases to the value in your companies, are credits, and decreases to shareholders equity, which is lost money of your business, basically, money that is, reductions in the value of your business. That is going to be a debit. And expenses are always debits. Revenues are always credits, right? Remember talking about that. Capital stock is money being put into your business, right? So if money is being put into your business in the sense of somebody gives you cash, It's a debit to cash, a credit to stock, right? So there you go. There's your increase to the value in your business. Any gains, of course, are increases in value. And dividends are decreases in value in your business as well as losses. All right, so you're going to see these again in a few minutes in the sense of that you're going to see stocks are credits and dividends are going to be debits. All right, so just a reminder reaching back to those earlier chapters there. Okay, so with that, that's going to be those are called paid-in capital stock, because the idea is that a stockholder, is paying into the business, meaning they're giving you money, they're paying in capital being the assets, okay? So when a stockholder buys stock, what they're doing is they're getting a piece of paper from the corporation saying they're a partial owner, and what they're doing is they're giving the corporation cash in order to run its business. Well, not always cash, but to keep it simple, we'll say cash. The idea is that they're paying in something, whether it's cash or they're giving in equipment, they're giving some sort of capital, some sort of an asset. Right, and like I said, the other way you have money in the business is going to be net income, right? Because revenues go into your business. If you remember your closing entries from chapter 4, we talked quite a bit about closing entries and how they close out to retained earnings. All right, so just a picture of what an equity section of the balance sheet would look like. The stockholders equity section, you've got your paid in capital and you've got your retained earnings. Your total stockholders equity be $410,000 in this example. All right, so let's talk about, I'm going to have to change the way the slide looks just a second. Okay, just had to change the view on this slightly. So let's talk about shares of stock and a little bit of the terminology surrounding them. If you are when you're initially doing the charter and all that good stuff, when you're filing with the state and you're filing those articles of incorporation, what you're doing is you're getting also a number of shares authorized. Basically, you're saying we want to have 1 million shares of common stock, or 5 million shares of stock, or 20 million shares of common stock. The point is that common stock that you're basically saying this is how many shares of stock I want are called the authorized amount of stock. So let's keep it easy. Let's say we have 20 shares of stock authorized. All right, you can add some zeros if that makes you happier, but for me giving this little lecture, let's just say we have authorized in our company, our corporation, we've got authorized 20 shares of stock. Okay? From there, maybe I decide I'm going to issue 12 of those shares. All right? What that means is I'm going to sell 12 shares of that stock out to the world so that I can, raise some money to run my business, raise some capital. So I had 20 shares authorized, but 12 shares issued. And you could also say right now I've got 12 shares issued, and the next term we're going to use is outstanding. All right, that doesn't mean like fantastic outstanding. That means outstanding like out in the world. All right, so I've issued 12 shares of stock right now, and they are outstanding, meaning they're out in the world in shareholders' hands. The next terminology is outstanding, as I said. Okay, so issued and outstanding, as long as all of the ones I've issued are out there in the world, then they are also 12 shares that are outstanding. However, I might decide I want to repurchase my own stock. Okay? When I go out into the world and I say, you know what, I'm going to buy a few shares of my stock back, that stock is called treasury stock. When you repurchase your own stock, it is called treasury stock. All right, so I had 20 shares authorized. I put 12 out there in the world. There was 12 issued and outstanding. Let's say I buy 2 shares of my own stock back. All right, so now I have 2 shares of treasury stock, and so I have 20 shares. Ready for this? I've got 20 shares that were issued. No, sorry. I'm going to mess it up myself. I've got 20 shares that were authorized. I have 12 shares that were issued, but I only have 10 that are still outstanding. You get it? So there's the difference there. I had issued 12, but only 10 are still outstanding, meaning that they're out there in the world. Okay, so the 2 shares of stock that I've got, I'm going to keep also on my shareholders equity section of my balance sheet. I'm going to keep it, and it's going to be called treasury stock, and oddly enough, it's going to have a debit balance. Okay, so whereas normally when you issue stock, it carries a credit balance, your treasury stock carries a debit balance. Okay. We talked about before that you have a few rights as shareholder, and one of your major rights is the fact that you can vote. You can vote in some matters. Sometimes you're asked to vote on certain things, like should we issue another bond offering, should we issue more stock, things like that. And if you're a shareholder, you'll get usually something in the mail asking you whether or not you're going to vote. It can be online as well if you've registered with the corporation, your email address. The other two rights that we haven't talked about yet is the right to share in distributions of earnings. So what this means is, for all the shareholders that I have out there, if I decide as a corporation that I'm going to pay $1 to every single shareholder I have out there, that means every single shareholder I have out there gets $1. I can't decide I don't like Timmy Jones, who is a shareholder of my corporation. I can't decide I don't like him, he hasn't been a very good shareholder, so he's getting nothing. That's not okay. The idea is that if you are a shareholder, you get the same amount as everybody else as a distribution of the earnings. The other piece is the right to share in assets on liquidation. What that means is if the company goes bankrupt and they have to sell everything off, and it gets complete, or it doesn't even have to go bankrupt, but if it liquidates, all right, we decide we're not going to run the business anymore and we sell everything off. The idea is that if there's anything left over after we pay all of our bills and pay all of our creditors and pay all of our taxes and so on and so forth, if there are any assets left, every shareholder gets their fair share of those assets.